In the ever-evolving world of finance, few assets have captured imagination like Bitcoin. Launched in 2009 by Satoshi Nakamoto, Bitcoin has grown from niche experiments to a global phenomenon, often dubbed as digital gold for its scarcity and resilience. Meanwhile, newer financial instruments like Yield Max by MSTY options income strategy have emerged, offering exposure to Bitcoin related strategies through MicroStrategy, a company heavily invested in Bitcoin. While both assets appeal investors seeking growth, they differ vastly in structures, purpose, and risk. Today, we're going to explore why Bitcoin remains a cornerstone of crypto world and highlights the significant risks tied to MSTY. Bitcoin, the bedrock of cryptocurrency. Bitcoin's appeals lie in the simplicity and strength as the first decentralized cryptocurrency. It operates on a blockchain, a transparent, immutable ledger that records transactions without intermediaries. This decision eliminates reliance on banks and governments, empowering users with financial sovereignty. With a fixed supply capped at 21 million coins, Bitcoin's scarcity mirrors precious metals, making it a hedge against inflation in the era of fiat currency printing. Over the years, Bitcoin has proven its staying power. Its prices, though volatile, has trended upwards, with milestones like surpassing $60,000 in 2021 and again in 2024, reflecting growing adoption. Major corporations including Tesla and Square have adapted Bitcoin into their balance sheet, while countries like El Salvador have embraced it as a legal tender. Exchange traded funds approved by US uh, Securities and Exchange Commission in 2024 further legitimizes Bitcoin, offering traditional investors easy access. Bitcoin's decentralized network, secured by miners worldwide, is another strength. No single entity controls it, reducing the risk of censorship or seizure. While critics point to its energy consumptions, innovations like renewable powered mining are adding to these concerns. For investors, Bitcoin offers a direct stake in a transformative technology, unencumbered by corporate governance or complex financial engineering. MSTY, launched in the year 2024, is an actively managed ETF designed to generate income through option strategies tied to MicroStrategies MSTR. Strategy led by Bitcoin's advocate Michael Saylor holds billions in Bitcoin, making its stock a proxy for Bitcoin's price movement. MSTY aims to capitalize on this by selling covered calls and other options, distributing premiums as monthly dividends to shareholders. It's marketed as a way to gain Bitcoin exposure with added income. But beneath the surface, MSTY carries risks and set it apart from owning Bitcoin directly. Before diving into MSTY risks, let's highlight Bitcoin's advantages. First, Bitcoin is pure asset. When you own the Bitcoin, you hold digital token with no counterparty risk. No company or fund manager stands between you and your investments. This contrasts with ETFs like MSTY, which introduces layers of complexity. Second, Bitcoin's global adoption is unmatched. It's traded on exchanges worldwide, accepted by merchants, and integrated into payment systems like Strike and Cash App. This liquidity ensures you to buy or sell Bitcoin with ease, often at a lower cost than niche ETFs. Third, Bitcoin's transparency is a hallmark. Every transaction is verifiable on the blockchain, fostering trust. MSTY, by contrast, relies on opaque option markets and MicroStrategies corporate decisions, which can obscure true risks. Finally, Bitcoin's long track record over 15 years offers confidence. Its weather crashes, regulatory scrutiny, and skepticism, emerging strong each and every time. MSTY, barely a year old, lacks this resilience, making it a speculative venture by comparison. The risk of MSTY, let's look at a closer look. Let's take a closer look. While MSTY seemed to be an innovative way to ride Bitcoin's wave, the structure introduces significant risks. Here are some concerns. MSTY's volatility is stark. with a reported 33.78 annualized volatility compared to Bitcoin 16.7 in recent data. This stems from its reliance on strategy, a leveraged play on Bitcoin. Strategy funds its Bitcoin purchases with debt, amplifying purchase swings. If Bitcoin dips, MSTR and MSTY can plummet disproportionately. For example, a 50% dip in MSTR stock could wipe out MSTY investors' capital, especially since MSTY employs option strategies that marginally losses. Unlike Bitcoin's decentralized nature, MSTY is tied to strategy's corporate health. If MicroStrategy faces mismanagement, legal issues, or bankruptcy, MSTY suffers regardless of Bitcoin's price. MicroStrategy's aggressive debt strategy, borrowing billions to buy Bitcoin, raises some concerns. A liquidity crunch, as seen in 2022 when Bitcoin fell to $15,000, could limit MicroStrategy's ability to raise capital, hammering MSTY's value. MSTY's income comes from selling options, a tactic that caps upside potential while exposing investors to downside risk. In a Bitcoin bull run, MSTY may underperform as its cover calls limit gains. Conversely, in bear market option trading, options premiums may not offset losses. This complexity confuses retail investors who may not grasp how options erode returns. Post on X note MSTY's 46% loss against the dollar in the first year, underperforming Bitcoin's 26% gain. MSTY's distribution are taxed as ordinary income. Unlike Bitcoin's capital gain treatment for long-term holders, this reduces after-tax returns. Additionally, MSTY faces regulatory risk as an ETF. A crackdown on crypto-like securities could restrict its operation or force liquidations, risk Bitcoin awards due to its decentralized status. MSTY's infancy, launched in 2024, means it lacks the historical data to assure its performance across market cycles. Bitcoin's 15-year-old history shows its rebound from downturns, but MSTY's untested strategy could falter in the prolonged bear market. Its maximum drawdown of 40.82% since inception signals potential for steep losses, less severe than Bitcoin's 93.7 historical drawdown, but concerning for fund meant to provide income. MSTY's performance hinges on strategy's premium, which reflects speculative fervor for Bitcoin. If sentiment soars, say due to the Bitcoin price crash or regulatory shifts, this premium could vanish, dragging MSTY down. Bitcoin, while volatile, doesn't rely on single company's hype, making it more resilient. MSTY's trading volume is lower than Bitcoin's, increasing the risk of price slippage during volatile periods. Bitcoin's massive liquidity with trillions of market cap ensures tighter spreads and easier exits. MSTY's niche status also means it's less understood, potentially deterring institutional support. Bitcoin's strengths, decentralization, scarcity, and adoption position it as a long-term store of value. Its role in portfolios grows as inflation fears persist and digital payments expands. Innovations like the Lightning Network promise faster, cheaper transactions, cementing Bitcoin's utility. MSTY, while creative, it is a high-stakes gamble. Its reliance on MicroStrategy's debt-fueled Bitcoin bet, coupled with complex options, makes it riskier than owning Bitcoin outright. Investors seeking Bitcoin exposure are better serving by holding BTC directly or via regulated spot ETFs, which avoids MSTY's corporate and structural pitfalls. For those drawn to cryptocurrency's potential, Bitcoin remains the golden standard. Its simplicity, security, and global reach outshine speculative vehicles like MSTY. While MSTY offers income, its risk, volatility, and leverage, taxes, and corporate dependencies overshadows its reward. As the crypto landscape evolves, Bitcoin's clarity endures, making it a wiser choice for investors betting on the future of money.